Hello, welcome to the Capital Employed podcast. Joining me in conversation for this episode is Ben Claremon from Cove Street Capital. In this episode, Ben gives an overview of his investment process. He also talks about two tech stocks he thinks are being undervalued by the market and have great upside potential. Before we jump into this episode, please make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okay, please enjoy my conversation with Ben. Hi Ben, thanks for coming on to the podcast. Who and what is Cove Street Capital and what is their investment philosophy?
Yeah, John, thanks so much for having me and letting me talk about myself and my firm. So Cove Street, we're based in Los Angeles, California. We have about 750 million under management. We are long only value investors, kind of a dying breed of small cap concentrated value investors. We do a lot of work on our companies and we concentrate our portfolio. I think in the two main strategies we run, 30 to 39 names in our small cap strategy, and the strategy that I co-manage, we have 20 to 29 names. Everyone has a quote unquote unique and distinct process. And so the question is, how do you really differentiate yourself? And so I'm happy to walk through our process, but I think what's more interesting to people is the nuances of our process and the distinctions and the way we try to differentiate ourselves. When I say we do a lot of work on companies, that's what I'm really referring to is, of course, we're reading financial statements and of course we're reading conference calls and talking to management, kind of just a basic blocking and tackling. But I think to be a really successful investor, especially when you run concentrated and you take large positions in companies, you have to find alternative sources of information. And, I hesitate to say the word edge because these are relatively efficient markets. US small cap and mid cap markets are at times inefficient, and there are obviously opportunities here and there. But I think the humility of being a conservative investor requires you to say, most of the time the market's going to be efficient. So you have to figure out something, some angle, some information source, some contrarian perception that other people don't quite, can't quite come up with. So we're always doing kind of not what I call non-Wall Street oriented things. I'll give you an example because I think this is actually really, pertinent and relevant. So today, I spent most of my day listening to a space/defense oriented conference. And this had nothing to do with investing. One of our companies, Viasat, was one of the sponsors of this space conference. And this was really what it was about is how do we defend our assets in space? That's in terms of, the physical satellites. How do we handle cybersecurity in a world that's more and more connected? And so there were Viasat people discussing these issues with top military personnel. Again, this has nothing to do with quote unquote Wall Street. This is one of our companies that happens to be public. It's one of our largest positions. I learned an incredible amount about the opportunities they have by listening in on this presentation. I think that's a good example of the way that we try to differentiate our perceptions, get information that other people might not be looking for. Doing this work is necessary but not sufficient to be successful. I think being successful requires what I would say the art and the science of investing. The science is, modeling and, understanding returns and margins. And then the art is marrying the qualitative and quantitative data that you gather to make investment decisions, and then dealing with all of the behavioral stuff associated with buying and selling, position sizing, and what happens when positions move against you, and what happens when you've been wrong for 3 years, all of those behavioral biases that start to kick in. The way I look at investing is that to be successful, no matter where you are and what markets you're in, it's a combination of qualitative, quantitative, and behavioral. And so our process is designed to mitigate behavioral biases, to develop an edge through, access and unearthing of alternative sources of information. We run concentrated. That means we're not going to, we don't have 100 names. We don't need that many new ideas. Focused on high conviction ideas whereby our three pillars come together: business, value, and people, with a large focus on the third one, which is the people.
And what type of business do you like to focus on?
Ideally, you'd invest in a business that's getting more valuable every day, run by people who understand capital allocation, and that trades at a relatively large discount to your assessment of intrinsic value. So those are our three principles: business, value, and people. And when they all align, that would suggest that we'd be investing in a large position in that company. How do you figure that out? And what are you doing to understand, the type of company and the type of businesses you're looking at? We measure all of our companies, everything that we own and everything that we look at, on a 1-to-4 basis, with a 1 being what we call a true Warren Buffett stock and a 4 being a true Ben Graham stock. And let me just flesh that out a little more. So Ben Graham, for people who are not familiar with the father of value investing, was a balance sheet oriented investor. He was looking for things that were statistically cheap securities, things that were trading at less than their tangible assets. He was almost agnostic to business type. He was more interested in buying something cheap. And the evolution, what Warren Buffett started as a Ben Graham investor because Ben Graham was his mentor. But the Buffett's evolution was to realize that you sleep much better and you have the opportunity to compound your capital much more consistently if you invest in better businesses. And so that's kind of the personal evolution that I've been on as well. I started off as a Ben Graham oriented investor. I like things that were cheap. Cheap was the only thing that was important to me. And as I've evolved and made any number of mistakes, I've come to appreciate the value of paying up a little bit for a better business. And so, what do we mean by that? What is a what we call a 1 or a true Buffett on our scale? So it's a business that's getting more valuable every day, and that means that it has a moat around its business, right? There's some kind of barriers to entry, or there's some network effects that benefit the company. That means it has high margins and returns. It means that there is an opportunity to reinvest capital at a high rate. And then you get into management, right? Because the business and management are highly intertwined. What kind of people are running it? Do they have integrity? Do they understand capital allocation? Do they speak your language? Do they speak in terms of earnings per share? What's going to happen next quarter? Or are they thinking 10 years out and talking about free cash flow? There are a number of qualitative and quantitative metrics that we use to determine the quality of the business. Ideally, we would invest in as many what we call true Buffets as you possibly can. In a world where markets have become relatively expensive, I don't think that's particularly controversial. The best businesses in the world trade at very healthy multiples, and in a lot of cases, multiples that are much higher than they have historically. So you have to be a little more nimble and a little less dogmatic in order to find opportunities at the current moment. What we've been having success in is companies for which the market is not sure about that Buffett and Graham dividing line, or a company that is perceived to be a Graham, a mediocre business trading at a great price, but in reality, something about the business has changed, whether that's a capital allocation changed or there's been an inflection point that allows the company to actually be more Buffett-like. And so what we would call a Buffett stock is a good business trading at a fair price. Stocks that are at an inflection point can be good investments because not only will you see the earnings and cash flows play out in a more positive way than the market is expecting, but you also can benefit from a multiple expansion. That's kind of where we've been finding the most value in the market today.
Can we talk about 2 stocks maybe in your portfolio that you're optimistic is still going to have good returns going forward over the next few years? And what was the thesis behind investing in those companies?
So the first one is Viasat. It's a satellite connectivity company. What that means is that instead of getting your broadband from, Charter or Comcast or CenturyLink, whoever your broadband provider is, there are areas in the country, in the world, where, it doesn't make sense to lay expensive fiber or cable, and are better served from a connectivity perspective from what are known as high throughput satellites. Viasat was really the disruptor and the innovator in the high throughput satellite world. We've owned this company, I think since 2014 or 15. We have a unique lens. Remember, as I was talking about, you want a unique perspective on a company so that you can, maybe understand things that other people can't. My colleague Eugene Robin worked at the company. His father worked there. We have a very close relationship with management. So we just think we have a nuanced understanding of the opportunities and threats that maybe people don't have at first glance. Very simply, people think that Viasat, who I mentioned was the disruptor in the high throughput satellite world, is being disrupted by companies like SpaceX's Starlink, OneWeb, and then Amazon has their own satellite constellation planned as well. Our contrarian perception is that the total addressable market for real connectivity outside of urban areas, so whether that's rural broadband to your home, whether that's maritime out in the ocean, whether that's in-flight Wi-Fi, or whether that's military gaining connectivity in places that's never had true high-speed connectivity, we think the total addressable market is large enough for all the players to compete, and that we're going to see an absolute renaissance in connectivity in places that it's never been. And companies like Viasat and even SpaceX are going to be providing that. And so people think of Viasat as just someone who's competing for a rural person in Oklahoma who, has never had fiber connectivity. When in fact, the real opportunity for Viasat is to be the leading player in in-flight Wi-Fi. What that means is in 24 months, when there are 2 new satellites have been launched, Viasat's going to be providing transatlantic and trans-Pacific connectivity. So that means if you're flying from New York to Tokyo or New York to Amsterdam, you're going to have connectivity on that flight in a way that you never have had before. And so that's one big market for Viasat that they are really uniquely positioned to tap. And then secondly, the military. The military's never really had fast connectivity in the places where it really matters. Think the Middle East and Asia. And when Viasat launches its 2 satellites in mid to late 22, they're going to offer connectivity over Asia and over the Middle East and Europe to the military in a way that they've never had real-time connectivity that allows the modern warfighter to have immediate information and intelligence. And so that's our contrarian thesis, is that, don't worry about rural broadband. That's just, if that's an opportunity that will be fine for Viasat, and, SpaceX and the competitors might do really well there, but really Viasat's going to be an in-flight Wi-Fi and a military company in a few years. And so, given all that, we think the stock is really, really undervalued. My colleague, the stock's in the high 40s, low 50s right now, and we think it's worth in the hundreds with very conservative assumptions. We say that as conservative value investors with a fair amount of trepidation, because we don't like to put out these huge headline price targets. We just think we have an understanding of this company that other people don't, because they haven't taken the time, and it's a little bit complicated. And the type of sell side analyst who covers this company is a kind of a normal cable and telecom analyst who doesn't really understand the military side. And so that's one. The other stock I'll talk about is Lumen Technologies. This is a little more simple. So Lumen is formerly known as CenturyLink, another connectivity company. CenturyLink, the modern CenturyLink is a combination of what a legacy CenturyLink business with Level 3, which was an enterprise business-focused connectivity company. And so think broadband connectivity and all the services associated with your business. That's the Level 3 side. And then CenturyLink was dominated by telephones and, the TV bundle and, slow broadband in rural areas. And so those 2 companies married, and it was a marriage that never made any sense. The only reason Jeff Story, who's now the CEO of the combined companies, the only reason he sold, because he was the CEO of Level 3 when CenturyLink bought it, the only reason he sold was because they offered such an exorbitant price. What we know is that he never really wanted to be involved in the post-merger company, but it was such a disaster that he was named COO to start, and now he's the CEO. Our sense and our relationship with the company suggests that every day they are focused on figuring out how to unmarry these assets that should have never been married. Company's actually having an analyst day tomorrow. I don't think that we're going to hear anything about the separation tomorrow, but I do think over the next 6 months, you're going to hear about interesting ways that they're going to highlight the value of their fiber assets. Fiber is I think COVID has shown that having fiber in the ground to be able to provide really fast connectivity to both business and consumers, it's a piece of infrastructure that we cannot live without. We're on Zoom calls all day. Kids are on Zoom calls right now for school. People are consuming an enormous amount of bandwidth when it comes to video and video games. Businesses, if all of your applications are in the cloud, you need connectivity. Fiber is becoming an infrastructure asset that people are paying very high multiples for. We think that there's industrial logic for consolidation of the legacy CenturyLink business. That's the small business and consumer broadband business. And then there are really, really attractive multiples being paid for world-class fiber assets like the level 3 side has. We think that there's a capital allocation change and maybe some kind of split or spin or sale, some kind of transaction that separates these two businesses and highlights the value of the individual assets. So, and I'll close just with 2 points on that. The company put out a slide in June of 2020 saying that if you're just putting very conservative multiple on the CenturyLink side and a little more aggressive multiple on the level 3 side, on the business side, it was giving you a stock price of 24 to 35, and the stock is 13.50 today. And that was a company's evaluation. We think the numbers could be higher, but those were conservative estimates. And the last thing I'll say about this is when we did a podcast on Lumen, as I mentioned, and when CEO Jeff Story listened to our podcast, his response was, "These guys get it." Viasat's insanely undervalued in our view, but Lumen is just, I've never seen a company in my career that is more set up for some kind of structural change. I believe, given our understanding, we were level 3 shareholders, so we knew Jeff Story. Given what we know of him and what he said, in public, and what I've in his reaction to our podcast, all of that is suggestive to us that they're going to find a way to do it. And if they do find a way to separate the assets, we think the sum of the parts value is much, much higher than the current stock price.
What was the ticker for that one? Was it LUMN?
MN, LUMN, Lumen Technologies.
Okay, that's great. Yeah, thanks, Ben, for sharing those two companies. Where can listeners go to find out more information about you and Cove Street Capital?
Yeah, as I mentioned, covestreetcapital.com. I think if there's anything that we're comfortable sharing. We're not an opaque hedge fund. We're a long-only fund. You can see our holdings every quarter. We talk about our ideas. I think people always know what we're thinking because we're pretty out there. And so if you go to our website and you go to our thoughts tab, you will see numerous interviews and commentary from us. So I think that's a good place to go. I'm pretty active on Twitter. My Twitter name is The Inoculated Investor. If you're wondering what that is, it was the investment blog that I started back in 2009. It's no longer active, but I built up a brand being known as The Inoculated Investor. So you can follow me on Twitter, Inoculated Invests, INVES. We're pretty out there, honestly. There's a lot of, I really like the podcast medium, as I mentioned. So there's a number of interviews with us, whether it's talking about an individual idea or our process. And, we're always happy to engage and interface with people who have questions or are interested in our strategies.
Thanks so much for coming onto the show. It's been a pleasure to listen to you.
Yeah, it's been great. Nice chatting with you. Maybe we can do it again sometime.